A recession is imminent. How will home prices hold up? That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here is the market data that you need to make an informed buying or selling decision, or help your client to do the same. Let's start with a quote from Fannie Mae. On a quarterly basis, home prices rose as seasonally adjusted 1% in Q1 of 2023. The fact that prices rose slightly in the first quarter is evidence of significant pent-up mortgage demand despite ongoing affordability constraints. I wanted to begin with this quote because it supports what I have been telling clients will happen if they wait for better rates before they buy. They're going to end up paying more for the home. Why? Well, because everyone else is also waiting for the same thing. Despite all the headlines about home prices coming down, the data now shows that prices in fact went up. And that is largely because the slight drop in mortgage rates from the 7s and into the 6s motivated people to get back into the market. And good for them, because mortgage rates are not done dropping. That means that prices are not done going up. And when rates get back into the 5s, all the savings those who waited thought they would get from a lower mortgage rate will be wiped out, and then some, as a result of paying a higher price for a home. But how do we know that home values have stabilized? Well, as we read from Fannie Mae, we had a 1% rise in Q1, and now let's take a look at this month-over-month data from Case-Shiller, Federal Housing Finance Agency, and CoreLogic. Keep in mind, this is the leading indicator. We started last year very strong, and then around the middle of the year started to see home prices slightly decrease, and a lot of that was due to rising mortgage rates. Then fast forward to the latest information, which is February for FHFA and Case-Shiller and March for CoreLogic, and we start to see the turn happening. It's clearly safe to say that the worst in home price declines is now behind us. Now I realize this is not what you're seeing in the news, but the news is wrong. To beat the horse to death, Black Knight said this: just 5 months ago, prices were declining on a seasonally adjusted month-over-month basis in 92% of major US markets. Fast forward to March, and the situation has done a literal 180, with prices now rising in 92% of markets from February. But what about home prices in the context of a recession? The talk of recession is going to heat up and continue to heat up as we go throughout this year and as the economy continues to slow down as a result of the Fed's actions. The summary of the March Fed meeting, giving the Fed's assessment of the potential economic effects of the recent banking sector developments, was that they project a mild recession starting later this year with a recovery over the subsequent 2 years. The question is, how would housing be impacted? How would that affect prices? How would that affect mortgage rates? So, the first question, how would housing be impacted? Bankrate summed it up pretty well. During a traditional recession, the Fed will usually lower interest rates, and this creates an incentive for people to spend money and stimulate the economy. It also typically leads to more affordable mortgage rates, which leads to more opportunity for home buyers. But what happens with prices during a recession? Well, the first thing we can say is that a recession doesn't mean falling prices. A recession also doesn't mean a housing crisis. In the last 6 recessions, 4 of the 6 times, home prices actually appreciated. Twice they depreciated, once marginally in the early 90s, but what everybody remembers is 2008, when homes lost almost 20% in value. A lot of people got hurt, and when they hear the word recession, that's what they think of, because the meaning of the word recession changed back in 2008. So how would a recession impact mortgage rates? Well, it typically means falling mortgage rates. If you go back and look at those same 6 recessions in our country, you see that each time we've seen mortgage rates fall, going all the way back into the early 80s. Now, regardless of whether or not we are in a recession, we are living in one of the foundationally strongest housing markets of all time. There are 2 reasons why I can say that. The first one being the current rate on existing mortgages. According to the Federal Housing Finance Agency, as of the 4th quarter of last year, the majority of mortgages were below 5%. That's over 80% of existing mortgages below 5% and over 50% being below 4%, which means that only 20% of people have mortgages with a rate higher than 5%. People are going to work as hard as they can to keep those low-rate mortgages on and are highly unlikely to default. They all have equity and would sell before ending up in foreclosure anyway. Not to mention, they can't exactly go out and rent an apartment for the same mortgage payment that they're paying. And that is a very strong foundation to our market. The second reason is that Americans are sitting on tremendous amounts of equity. Almost 68% of people have either paid off their mortgage or have at least 50% equity. When you break down the numbers, 38.7% of people in this country own their home free and clear, and that's amazing. And 28.9% have at least 50% equity. So you add those two together and you get almost 68% of people are in a position where they either have paid off their mortgage or have at least 50% equity. That is an extremely strong foundation for homeowners across the country, and just an additional reason why a recession will not adversely impact our housing market. That's a wrap for the May monthly market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.